Welcome back to my YouTube channel. A brief look at what we covered in Unit 2. In Unit 2, we learned generally accepted accounting principles, GAAP, and International Financial Reporting Standards, IFRS. We learned that GAAP are principles established as a regulatory framework that guides an accountant in preparing reliable and comparable financial information, while IFRS are a set of international accounting standards which state how particular types of transactions and other events should be reported in financial statements. We also looked at the various concepts and conventions under the accounting framework, some of these being business entity concept, going concern concept, the accrual concept. And two of the three conventions looked at were consistency and conservatism. Now, Unit 3, the balance sheet and the accounting equation. We will be covering the following areas in this unit: definition of the balance sheet, defining assets and liabilities and capital, the accounting equation, and prepare a balance sheet based on a given scenario. Now we look at the balance sheet. The balance sheet, otherwise referred to as statement of financial position, is a statement showing the value of assets, liabilities, and capital of a business. The statement of financial position summarizes the assets, liabilities, and equity balances of the business at the end of the reporting period. In summary, the balance sheet is a statement that shows the value of assets, liabilities, and capital or owner's equity at a given point in time. Defining assets, liabilities, and capital. Assets are the economic resources that a business owns. Assets are resources or items with a dollar value that are owned by a business. Assets are classified in two categories: non-current or fixed assets and current assets. Non-current assets are assets or resources which have a long lifespan, bought with the intention to use them in the business and not with the intention to simply resell them. Non-current assets are those assets which are used in the business over a number of years to generate sales revenues and profits. Examples of non-current assets are land, property and plant, building, fixtures and fittings, furniture, equipment, machinery, motor vehicle. Current assets. Current assets are those assets which are expected to be converted into cash within 12 months of the reporting date. Current assets enable the daily operation of the business. They change constantly, both in value and quantity, and are expected to last for 1 year or less. Examples of current assets are inventory, accounts receivables, cash at bank, or cash in hand. Liabilities. Liabilities are what a company owes to non-owners for assets, products, or services. Liabilities include amounts owed by the business for goods and services supplied to the business and for expenses incurred by the business that have not yet been paid for. Liabilities are classified into two categories: non-current or long-term liabilities and current liabilities. Non-current liabilities. Non-current liabilities are those obligations which will be settled 12 months from the reporting date. Long-term liabilities often are bank loan or loans from other financial institutions, or they may be loans from a good friend or a family member. Current liabilities. Current liabilities or short-term liabilities are sums owed by a business which are to be repaid in a short period of time, usually not exceeding 30 days. Current liabilities are those obligations which will be settled within 12 months of the reporting date. Examples of current liabilities are creditors or accounts payable, accrued expenses, and bank overdraft. Capital or owner's equity. Capital comprises the funds invested in the business by the owner, plus any profits retained for use in the business, less any share of profits paid out of the business to the owner. Capital is investment made by the owner to start the operation of the business. On a balance sheet, assets can be recorded in one of two ways: order of liquidity or order of permanence. Order of liquidity. This is where cash or near cash items are recorded first, down to the least liquid asset of land or property. Order of permanence. This is where assets that have a long lifespan, such as land, is recorded first, down to the most liquid asset of cash What is liquidity? Liquidity, or near cash or easily converted into cash, refers to when a firm has the ability to pay its short-term financial obligations when they become due. Before we continue looking at the construction of a classified balance sheet, we'll consider the accounting equation. What is the accounting equation and how does that relate to the balance sheet? The accounting equation is a simple expression of the fact that at any point in time, the asset of the business will be equal to its liabilities plus the equity or capital of the business. The accounting equation shows the relationship of the elements in accounting, this expressed in a mathematical form. The accounting equation expression is resources, what they are, equal to who supplied those resources. So it's assets equal liabilities plus capital or owner's equity. Now we'll look at 3 questions that will better illustrate the accounting equation. We are given the value of assets and capital and to determine what the liabilities are. That's question A. Question B, we're given assets and liabilities and need to determine capital. While C, we don't know what assets are. We know the value of liabilities and we know the value of capital. So we see where the answers to the question posed are: for A, the liabilities is 300,000, capital 220,000, assets 1 million. How did we get that? The solution are as follows. You will notice that what we had to do with A is a simple arithmetic. 500,000 minus 200,000 give us 300,000. B, 300,000 minus 80,000 give us 220,000. And C, to determine assets, 450,000 plus 550,000 equals 1 million. Next, we'll be looking at analysis of business transactions. The accounting equation is used to value the dual effect of the daily changes of a firm's assets, liabilities, and capital. In other words, with these basic accounting elements, there's always equality. Examples of effects of transactions on the accounting equation. So we'll look at some examples. So you look on the table here, have transactions in the first column, next assets, the second column, third column comes to liabilities and capital. The fourth column states the effect of the accounting equation. So we look at the first transaction, introduction of 600,000 to start the business. So we realize that asset would increase and capital would increase. So each side increases equally. We look at the 2 other. The second transaction, purchase of shop building for 300,000, we'll see that 2 assets are affected, right? So we purchased a shop building. There is an asset of building now, and cash was used. So there's an increase in one asset and a decrease in another asset. So a plus and a minus on the asset side, resulting in a cancelling out of each other. And there's one other transaction, purchase inventory valued at 70,000 on credit, creating a liability. So you note with this transaction, an asset is increased and liability is also increased or created. So each side receives equal increase. You can take note of the other transactions and see what their effects are, and allow a few seconds for you to look over before we go into the next section. So far, we've realized that the accounting equation equates to the balance sheet. The accounting equation is a fundamental basis for the preparation of the balance sheet. As such, it is sometimes referred to as the balance sheet equation. Now we will prepare a balance sheet based on the following scenario. Let's consider this question, shall we? John James decided to open an auto mechanic shop on January 1, 2017 with the following items: property and building valued at 2.5 million, motor vehicles valued at 2 million, computers valued at 700,000, inventory valued at 850,000, equipment valued at 1.5 million, cash at bank of 500,000, and he had cash in hand of $75,000. Also, Mr. James owes for the motor vehicle, equipment, and computers. He also owes suppliers $450,000 for the inventory purchase. We are required to construct a classified balance sheet and determine his opening capital as at January 1, 2017. Now for the solution, given the scenario. Please take note of how the balance sheet is constructed. First, we must have the name of the business first, followed by the name of the statement and the date on which the statement is prepared and the period under review. In this case, the name of the business is John James Auto Mechanic. Name of the statement is balance sheet. So we'll have balance sheet as at 1st of January 2017. Take note of the headings. We have assets. You see, notice assets is broken down with have in the two categories as mentioned earlier, non-current assets and have our non-current assets of property and building valued at 2.5 million, computers 700,000, equipment 1.5, motor vehicles 2 million. We'll add that up and we'll come out at total non-current assets being valued at $6.7 million. Next category, current assets. Current assets of inventory valued at 850,000, cash at bank 500,000, cash in hand 75,000. We sum that up and we get total current assets of $1.425 million. We are going to adjust current assets by current liabilities. So we're going to subtract current liabilities from current assets to get what our working capital is. So in this case, the current liabilities is creditors of 450,000. So we're going to subtract 450,000 from the 1,425,000 and we'll get 975,000 to be our working capital. So we add the working capital to the total current assets and we'll of 6.7 million and we will get $7.675 million. We're going to subtract long-term liabilities of long-term loan of $4.2 million and we're going to get $3,475,000 and we'll balance the balance sheet with capital of similar amount of $3,475,000. Right here our balance sheet is balanced. Now we have come to the end of our presentation on balance sheet. Thank you for tuning in. Please click notification so you can know when the next video is out. Upcoming Unit 4, the following topics will be covered. Double entry system of assets and liabilities and capital and the T account. If you found the information useful, please like, share, subscribe.